Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is August 19th, 2025, and today on our call we have the CEO, Greg Smith from Thinkific. Thinkific trades on the TSX, or the Toronto Stock Exchange, under the symbol THNC, and it also trades on the OTC under THNCF. The company is currently trading at $1.80 with about 68 million shares outstanding, or about $122.5 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Greg, great to have you here. Thinkific's a company that we've been tracking off and on here for the last 6 to 12 months. You guys have been around for a little while. And happy to have you on here, and certainly happy to have everyone get to know the business a little bit better. So why don't I just hand it over to you and we can start your presentation.
Thanks. Pleasure to be here. Appreciate you inviting us. Okay, so all can see my slides here, so I'll dive in on those. So a little bit high level about Thinkific. Essentially, we are focused on powering top learning businesses, and really what that means is we help customers of ours who sell their training or expertise. Initially, that started out as courses. We help you create and sell your own online courses, and has grown from that into beyond courses, really all sorts of learning products. So whether that's courses or downloads or now communities and other forms of essentially digital products where you're sharing knowledge and expertise with your customers or our customers' customers, their students, and generally where they are looking to monetize that, so generate revenue from it. Sometimes that revenue generation is indirect, but a lot of the time it's direct revenue generation where they're selling the products they create on Thinkific. Or another way to put it, it's a little bit like Shopify, but for digital products instead of physical ones. So I'll just give everyone 20 minutes to read through this. As a former lawyer, love that one. Okay, so just a quick glance at some of our metrics. Everything I'm going to talk about numbers-wise is going to be in USD, except if we get into share price and valuation, just because we trade on the TSX, I will talk Canadian, but everything you see in the deck is USD. So at a high level, this is looking back over the last 12 months, 71 million in revenue, US growing at 13%. And then I'll start in the top left there. The 61 million of that is recurring revenue, just means it's either on contract or customers have their credit card down, paying a bill monthly or annually. We also have a growing payments business. The payments volume that you see, the 242 million, that is the payments that we process through our own payment processing. And then gross merchandise volume is a bigger number. And I can get into the breakdown of how this all works as to what customers are processing on Thinkific, but not necessarily through our payments. Our average revenue per user, the revenue we generate each month, this is a monthly ARPU, is $169. And that's grown 9% over the last year and continues to grow. 52 million, again, US on the cash on the balance sheet. We've been adding to that every quarter, and adjusted EBITDA, 3.8 million. So just a high level here, before I get into everything about what we do and some of the strengths and opportunities here, if you're reading the analyst notes, some of the stuff you'll see is as you flagged, $121 million Canadian market cap, but sitting on 52 million US cash and 71 million in revenue and growing and profitable and adding to the balance sheet every quarter. We've made some strategic updates and changes that I think are really exciting for the future. And so, some of the notes you see in the analysts again is just minimal downside because we are profitable, generating cash flow, have significant cash for risk mitigation, and are leaning into a new strategy that represents a lot of growth opportunity for us. Just to share a few other things, a lot of awards recently from Trust Radius and G2, as well as Time. One of the reasons we're proud of these is they're really driven by customer feedback and broad customer feedback. Great leadership team. This is a team that I just rebuilt over the last year. Some are quite new, but have been around long enough that I'm confident we've made some really good choices here. And so pretty excited, especially with the additions here of Amanda, Ryan, Elise joining us. Kareen's been longstanding on the team and driven a lot of value, but this was a big step in terms of being able to initiate a new approach and strategy and some culture changes to drive for a faster growth rate in the future. So now I'll get into just sharing a little bit more about what we are and what we do. As I said, we're a learning commerce platform. And so this just means that we help our customers build their own websites and their own learning products like courses or membership communities where they can charge for access and deliver both impact to the students that are learning from them, but also generate revenue from it. And so that is different. One place where people sometimes get confused is that is different than a marketplace. So there's no place where you can go on Thinkific and say, where are all the courses that you offer? We don't sell any courses. Our customers do. So we have tens of thousands of websites supported by us. Similarly, how you can't go to Shopify and buy a t-shirt, you can't come to us and buy a course, but our customers can run a marketplace if they want. So it's tens of thousands of websites hosted on us, each delivering their own different learning programs and generating revenue in their own way. And the topics really range from sewing to corporate finance. Is all over the map in terms of topics, which gives us broad diversity in terms of economic impacts. And allows us to really focus on what we do best, which is helping people create and sell their own learning products where they get to have a positive impact on their customers. So a little bit more about who our customers are. Again, the commonality here is they are taking their training or expertise, packaging it up on Thinkific and selling it to their customers, their students. It's a lot of training companies and academies, some highly successful subject matter experts, and then some businesses that have added a significant training component to what they do. We sit in a fairly large and fragmented space in the learning software space. We've really carved out an area that I'll get a bit more into, but it's a huge TAM in this space, which each of these areas I've highlighted here sort of playing a different role or focused on a different segment of it. But we've carved out a specific segment that has a significant SAM, serviceable market for us, and or a significant market for us to address based on our unique ways of serving it and the kinds of customers we're going after. Or to break it down a little bit more, we're sort of between, there is a group of companies that are more going after creators, people just getting started, people starting a business. That we have played in that space and found it to be relatively lower price point. People are looking for an all-in-one solution, and there tends to be higher churn in the customer base there. And so we've moved quite a bit up market from there. We typically serve mid-market customers, medium-sized and SMB businesses that are more established. This allows us to charge more, offer more specific needs for those customers, and really focus on the ones that we found in our data have the best unit economics across the board for us. So they tend to be lower churn, stickier, stay longer, willing to pay more, and they're willing to grow and scale with us in terms of what they spend with us. And then another group of businesses that we bump up against occasionally is more the enterprise or LMS solution. These are different than us, and then they tend to be going after a much larger customer, but they're also not as focused on commerce. Whereas for them, they may bolt on or integrate with a commerce solution. Commerce is really native to Thinkific, and I can get into a bit more of what that means, but it's deeply integrated in everything we do, which just means we're really good at helping our customers generate revenue from their learning products. So a bit more broadly, some of the things that are in our product and what we offer as a software company. We allow people to create their learning products. So creating courses, build a website, build digital products, create these membership communities where they can invite their customers to participate. Then we give them all the tools to sell it, from payment processing to marketing funnels, email marketing, tax solutions. And then we let them engage with their students. So they can bring people into these courses or communities or membership sites, engage with their own customers, and really manage the business. And more, we're building AI empowerment across the board here. some of the feedback we get, and one of the things we really focus on is being really easy to use. This definitely sets us apart from other software in the space. I think easy to use should be table stakes for software. And so for us, it's always been an area of high investment, and it's probably why we get really positive feedback from our customers on this. But it is something that also sets us apart against a lot of competitors. Another area where we're leaning in competitively in terms of differentiation is commerce as a competitive advantage and really differentiating there. So we've invested a lot here and the takeaway of really is that when customers use our commerce solutions, they generate more revenue, and significantly more. A lot of times we're seeing them have 20% larger transaction sizes, or significantly more revenue because they're using the suite of tools we give them. This also is a revenue generator for us when they use these tools as well. And just as an example, Master Mike teaches martial arts, and when he started adding some of our commerce tools, we see a significant increase in his business in terms of the overall or transaction size, which also led to revenue increases. Some of this scale as well is or one of the benefits of our as we've scaled is adding tens of thousands of customers and having over our lifetime billions of dollars sold on Thinkific by our customers is really starting to open the door to more significant partnerships. Spotify is one more recent one. We're now in the UK, and the intention is soon globally you can purchase courses in Spotify. So if you're in the UK, but hopefully more countries soon, as you sign in, you'll see music, podcasts, audiobooks, and courses as the options that you can consume in Spotify. And we're a big engine powering that so our customers can create courses on Thinkific and then actually sell them through the Spotify network or deliver them through the Spotify network. I also want to talk a little bit about Thinkific Plus. So part of our shift recently is to lean into more and more of our larger, more successful customers. A portion of our business, about 25% of our revenue, is Thinkific Plus. This is our sales-led motion. So the rest of our business is more self-serve. They sign up on their own. They pick up a $100 a month price point. At Plus level, it's typically a $2,000 a month and up price point. It is sales-led, so they are speaking to sales, usually now signing multi-year contracts that have expansion revenue baked in. And this part of the business is growing quite rapidly. It allows us to service larger customers with excellent service and a lot of the needs they have to manage at scale. So there's a real growth opportunity for us here. And another area where we're getting great feedback, really just around our ability to service and support these bigger businesses and allow them to scale the volume that they're doing on Thinkific. Right Lane's a good example of this. They teach, it's a driving school online, but it's allowed them to expand their reach and generate additional revenue. This quote, I think, is from shortly after they launched, where they right away generated 1.5 million in revenue through Thinkific. Anaconda is another one, really amazing business that is got 50 million users globally, service over 1 million organizations. They're in 95% of the Fortune 500 companies, and they're really a platform for helping people deploy Python and R, which are programming languages for developing AI as the big use case, data science and machine learning. So they teach courses on Thinkific and are selling them out or delivering them out to their customers. So another great success story on our sales-led Plus plans. Levitt is another one that I think highlights use cases that you might not expect. So they're heavy machinery, farming machinery, and they do a lot of paid training around maintenance and use of their products. So in addition to selling heavy machinery, they're now able to monetize the training around how to use and maintain those. So even selling programs to their partners around maintenance of some of the equipment that they sell. Some of the priorities we're focused on, really doubling down on our strengths here. So leaning into communities and this connected learning concept. We're seeing more and more of the bigger customers care more about connecting their customers, their students together in learning communities. Definitely AI enabled and building agents on the back of the data set that we have from our customers. And then, of course, commerce and selling is a long-running strength of ours that we're continuing to double down on, all of these driving revenue opportunities for us. And so, that means investing in a few key areas, but largely focused on our strengths of AI, communities, ease of use, and helping our customers sell and deliver amazing learning experiences. As we look forward as investors, here are the things I'd be watching for in the future, and few predictors of our success. The first is growth in average revenue per user. This signifies some of our shift towards larger customers where we can generate additional revenue, and their adoption of Thinkific or of additional products that we sell. There's a lot of legs in ARPU. We've seen really good growth over the last few years in average revenue per user, but there's real opportunity for us to grow this significantly more. That in turn should lead to ARR, which is our recurring revenue subscription growth. That comes from increased larger customers, higher ARPU, and stronger retention numbers. And then finally, gross payments volume is the volume of sales our customers doing through our payment processing, and that creates another opportunity, another revenue driver. The commerce component being about, I think, 10% of our revenue today, or actually a little bit more than that, and growing at about 48% year over year right now. I was going to dive in quickly just to a more granular Q2 financial review, and then we can jump to questions. This kind of just demonstrates some of the things we're seeing from our recent investments. This is a similar slide, but on a Q2 basis. So I'll jump into kind of the specifics. Here's just another way of breaking down our revenue. So it's the same revenue left and right. On the left in the yellow, you see us breaking it out between subscription, which is the monthly fee, versus commerce, which is where we take a cut, or we have a take rate when people are processing payments, or essentially wallet share. And so as you can see, and that adds to the total revenue in the last quarter. On the right, you've got our self-serve customers and then our sales-led or plus customers. And so just to highlight two big growth drivers that we're investing heavily in on the commerce side, it's growing at 48% year over year, and on the plus side, growing at 25%. There is some crossover. These are not mutually exclusive numbers, which is why we've broken it out this way. So mutually exclusive between self-serve and plus, or subscription and commerce, but not necessarily. There is some commerce revenue in the plus revenue, but really good growth drivers there, representing 26% of our revenue on the right in plus, and the about 15-16% in the commerce revenue on the left there. So just showing how they're growing there, seeing really good growth in our plus, continuing to gain traction, and we've got a lot of levers there to put more fuel on the fire here, both in terms of product investment to unlock more here, but also just continuing to grow our sales team. And then commerce as well, another area where the nice thing about this is the commerce revenue is not really an additional cost to our customers, because they would be processing this. They would be processing somewhere. And so the fact that they process through us and pay us the percentage that they would pay for processing is additional revenue and growth for us as our customers are successful, but not seen typically as an additional cost to them. But it really aligns our success with our customers. So the more we can help them sell, the more revenue we can generate here. There's a lot of strength to our commerce business, even beyond what you would see in a physical goods business, just because it is digital goods. Our customers have really amazing margins. And so that just opens the door for potentially larger wallet share and take rate. And I think you've seen that in the growth in our take rate over the last few years as well. Strong adjusted EBITDA and profitability, and this translates very closely to cash as well. And then if we want to, I can dive in more specifically on the breakdown of how our commerce business works and some of the components, but I won't stop too much on that there. Some of the growth drivers as we look forward, definitely this move up market where we're investing in those larger customers that I've talked about, continued investment in commerce, which is another very strong growing area of the business, and plus. These all really work synergistically together. They're all part of the same big initiative strategically by us. And then as well, AI, agent learning. This is really recognizing that we sit in a great position from an AI competition perspective, in that we've got tens of thousands of customers who fed us terabytes of data that is amazing intellectual property, and we can then use that to train models to feed back to them. We're very specific that we'll use our aggregate data to train models, and then for individual customers, we'll train their own models for them. So we're not cross-sharing their expertise to other customers, but it really provides a powerful opportunity for us to be the place that they upload their content and receive excellent trained agents for them. I'll pause there and then we can jump to questions. I see there were
Excellent.
lots already coming in the chat.
Yeah, no, perfect, Greg. Thank you so much. Yeah, we've got some questions coming in. And a reminder to everyone that's listening, if you got questions you'd like me to ask Greg, please use that chat function and we'll ask that question. Greg, you mentioned well, you mentioned a handful of things that I was curious about. One is the competitive landscape. I mean, obviously there's other companies with teaching platforms out there, but what makes you guys unique? What do you think you guys can still improve on? But yeah, ideally, what's the competitive landscape look like?
Yeah, I think, and I can get into everything, including what we could improve on here, but just as a high level, if we zoom way out, I'll talk about some players that are not directly competitive, but they're in our space and people bring them up. So I think it's worth talking about them. One of them is the marketplaces, Udemy, Coursera, Masterclass. When I first created my own online course, in 2012, I did go looking for a solution just like what Thinkific is today, where what I was looking for is I wanted my courses on my website under my brand, where I owned the customer relationship and the revenue and the ability to make those decisions and build a business that I owned. What was available at the time was either these highly complex, designed for really large business LMS. They weren't designed with commerce in mind. They weren't designed with ease of use in mind, and you needed a team to run them. They were very expensive, and it didn't have things like conversion rates and commerce incorporated. So that wasn't a good fit. And that story is still true today. Those larger LMSs are not a great fit for what our customers are looking to do. And then similarly, I also available at the time, there was no Coursera, Masterclass, Udemy, but there were other marketplaces at the time. And the challenge there is I would have been putting my content into someone else's website under their brand where they control things like pricing and the end user relationship with the student. And so I wasn't building my own business. And we see the same needs from customers today. So those are two areas where we definitely differentiate quite significantly in what we offer. And so we don't bump up against them too much competitively. Another area is just social media in general. And there is a lot of learning that is happening on social media. It's even being monetized largely through ad networks, but in some ways paid as well these days. That is a real opportunity for us. It's a place we encourage our customers to use as a marketing stack. We do some integrations there that allow people to do distribution. The Spotify example is a great one, or a partnership there where we can allow distributions through networks like that. Where we get closer competition is when we get into some of the specific stuff that we offer, where it's mid-sized businesses focused on commerce. In that space, there's a segment of companies that I highlighted, some of them that are more focused on the creator, the individual, the person just getting started. And again, we had looked at and played in that space for a while, but where we really differentiate is we're getting better and better at serving the needs of bigger businesses or more mid-size, mid-market businesses, even 25 to 500 employees. And it's quite different. It's a small shift in the overall size of company, but quite different in terms of the unit economics and the price point they're willing to pay and the features they're looking for. So that's been a big strength and a place that sets us apart. And then generally, we set ourselves apart through things like ease of use combined with exceptional user student experience, like a learning experience combined with that commerce focus. And although there are companies that might do one of those things, we're the one really focused on doing all three of those together and setting ourselves apart that way.
Mm-hmm.
And then some of the ways we can do better is with this shift to larger customers, there are some product gaps that we can fill to capture more revenue there. And the other thing I'm finding is there are high switching costs for our customers if they ever want to move between platforms, which I think represents a power for us to leverage there of having more to sell them, because we know there are other solutions they need. And so that presents an opportunity either through M&A or R&D for us to build or acquire solutions that we can cross-sell to our existing customer base.
Mm-hmm. So you do see some opportunities on M&A side? That was going to be a question down the road. Is that something that you guys are pursuing?
Yeah, it's we are actively looking at it, and it's always a balance between build, buy, or partner. In some cases, we have chosen to partner and integrate. We have a very strong API and partner network, so we have a lot of integrations with the likes of Shopify to Wix or other MailChimp, lots of other products that we integrate with, Salesforce and HubSpot. But in some cases, we are looking more closely at acquisition. I think the lens we're looking at it with is it's got to be accretive to shareholder value. It's got to probably with a focus on increasing average revenue per user or the price point that we can charge by adding additional product value that our customers have already shown a willingness to purchase.
And then, Greg, how do you describe your sales process? How do you actually go and get customers?
Yeah, most of our customers are exposed to us through more of a inbound self-serve motion. So whether that's content marketing, paid ads, or other methods of going out and getting exposure, they show up on our website through search as well, search engine optimization, or more so now, or not more so, but increasingly LLM search optimization, showing up on our site or our other properties, and then signing up for Thinkific. And at that point, we're using all sorts of data enrichment and qualification to qualify those customers. And the larger ideal ones are then fed into a sales process where they speak to a salesperson. That process is typically sub 30 days to close. So quite a quick sales cycle. But again, your average price point there is $2,200 to $2,400 per month. So that's a pretty quick close process. The other one is the self-serve motion where they sign up on a trial and then eventually convert to $100 to $400 per month plan.
Mm-hmm. Okay, let's talk about the stock. You went public, a few years ago during COVID. A pretty successful IPO as far as how much money you raised. Obviously, the share price is significantly different than it was back then. Maybe describe the process. What's it like for someone from the sort of private domain coming into the public markets and sort of dealing with what you've had to deal with over these years?
Yeah, I mean, with the reason my experience prior to Thinkific was as a securities lawyer. I worked for a couple of big Canadian law firms. So I had been a part of taking companies public. I wasn't that long practicing, but enough to see some of it. And so had a sense of what it would be from that perspective. Obviously, it's new going through it as an issuer and from the company side. I think you're right, we had a really successful IPO. The downside of a super successful IPO at a time when valuations for software are high flying is obviously there's a follow-on potential downside to that, especially as markets start to shift the way that they did. And there's a lot more we could have done, or we can do in terms of our own growth rate and results to impact that more positively. The benefits are, I mean, the reasons we did it first are really to gain exposure in our customer base. It is work to some extent for that, to gain trust by being a public company. There is trust that comes with it. And of course, to raise capital. And so the capital's been a boon in that, we're in a very secure position now with an ability to invest in things like AI and other technology. And I think it gives us some protection on the downside risk, having cash on hand. And yeah, that's a bit of why we did it. And then obviously there's been not a great ride on a share price up to this point, but I think we're at kind of hopefully a real low where there's an opportunity to come up from here with the strategy and the team that we have in place now.
Mm-hmm. Now, you've got a share buyback in place. You're sitting on 52 million roughly US in cash. How does an investor sort of get in your mind in terms of capital allocation? How do you view what you should be doing with your cash right now?
Yeah, so capital allocation for us is very much looking at what is the return on investment, right? How are we going to generate a real return, either in terms of cost savings, time, and which is effectively cost savings, especially when most of your P&L is labor cost, and revenue generation. And so a lot of our allocation right now is more focused on R&D, is where we're considering it. We've been getting more efficient on the go-to-market, more focused on R&D. Partly because mostly because I think that's where we get the highest ROI, especially with this shift to larger customers. There's real opportunity and demand from them to have a stronger product, generate revenue growth for us, both on the commerce side and the sales-led side. So that's where heavy investment is. The other area of capital allocation that we are taking a close look at or continue to invest in is on the sales side, and that we have a fairly scalable sales process and team where we can continue to invest there and grow that sales revenue. But does that answer what you're looking for there, or is there more?
Yeah, it's clearly you see opportunity to use cash inside the business rather than buying back stock. That's indicative of some opportunities that you see out there. And then you talked about R&D. Maybe give us a better sense of roadmap. Like where do you really want to take this product? You mentioned sort of larger organizations. What is it about that sort of direction that requires this kind of R&D?
Yeah, so I'll step back and then jump there. One on just the use of cash. I mean, sitting on 52 million, there is a way to look at that says maybe that's too much. And so we do have the NCIB or where we're a buyback in place. I wouldn't rule out subsequent buybacks or even SIBs in the future, although I don't want to, we don't have anything imminent that is looking at that. Uh, we don't need that much cash to run the business because we are profitable and the investments we're making are paying off. Uh, so the opportunity there is potentially M&A that again is accretive to shareholder value, and that's what we're looking at. But there is also the possibility of potentially buying back stock, especially at prices like this. It's certainly a good investment from my perspective with our cash. But it also gives some downside risk in a slightly chaotic world between AI and everything else that is going on. It gives us some protection there to be able to continue to invest and grow and provide some security for shareholders. On the R&D roadmap, there's maybe two categories. One is plugging some gaps that I think we have today as we shift to larger customers. We're hearing, well, we'd like to see a little bit more around things like rules and permissions. So this is, if you're a bigger business and you have many people using Thinkific, you may want to assign them each different roles and give them very different permissions. Now we have this today, but it could be more expanded for them. Another area where we hear a desire is a lot more functionality in commerce, more detailed international processing and taxes and global processing. Again, we have this, but it can be more effective and detailed for our larger, more complex customers. And then another opportunity is where I was talking about, I think, to expand the offering either through an additional SKU or just additional product add-ons where our customers, because we have a fairly robust API, we can see exactly what other products they're integrating with. And then we get good feedback from our customers of where gaps are that they would like solutions provided by us. This is actually kind of how we came to the answer on commerce is we saw obviously that the majority of our customers are integrating with other commerce solutions to process payments, and they would be very happy to have us do that for them. And so when we built our own commerce solution, many were happy to switch over to Thinkific. We've had really strong penetration rates there across our customer base. And that generates new revenue for us, and our customers are happy using it because it's well integrated into the system. So they don't instead of using two pieces of software, they get to use one and get better data because it's tied together.
Yeah, that makes sense. I should have asked this question earlier. The breakup of the shareholder base, like how much is owned by insiders and maybe anything you can say about any other significant shareholders?
Yeah, sure. So there's myself, my brother, and Rhino Ventures, and then those are the big ones that were in before we went public. And then there are a number of bigger shareholders who've come in since we've gone public. So I'll focus maybe on those previously because that's where people tend to ask more questions. I'm holding of the 68 million shares, I'm close to 20 million. So I have a significant holding and single largest shareholder, which of course hopefully you see as having a real aligned interest with other shareholders to make sure that this goes well and get the best possible return for everyone. My brother is at about, I think about 11% of the company. He co-founded the company with me. He's still involved at an advisor perspective, but not beyond that. And then Rhino Ventures, who was a VC that supported us well throughout the entire growth of the company prior to going public and then doubled down on the IPO. They did recently sell a portion of their shares. Realities there is just they were coming up on end of life of their fund. And so as much as they would have preferred to stay and believe in the future, they had to do something for their unit holders. And so the nice thing is I believe they've now extended that fund so they have some more leeway with the remainder.
Gotcha. How much percentage-wise, how much does Rhino own, you figure?
There's a press release I'd have to pull it up and just double check, so I don't want to misquote the numbers here, but they are, or maybe Juhan, if you're on, you could take a quick look.
Yeah, if somebody can look that up, that'd be great. Okay. Why don't we jump on some of the questions that have come in, and then we can follow up with my last couple questions here. Okay, well, I think you answered Paulo's question. You said, why did Rhino Group sell? You said it was end of life for one of their funds. And as you said, now it looks like that's been extended. Um, okay, so Gilles says, were you surprised at the amount of money raised by the IPO? What was your role in setting the IPO share price?
Yeah, I pulled the press release. I think it's about 10.5 million shares that Rhino holds, representing 15.4% of the total shares. The other thing we did on the shares this year is, and hopefully people recognize this as my shared interest with others, is myself, Rhino, and my brother had special multi-voters. So we had 10 votes per share, whereas everyone else had single voters, 1 vote per share. And we converted all shares to common shares. So now everyone has 1 vote per share. Just from a general governance perspective, we felt that different time and place when we went public where that was more common to do. And now we felt it was more fair to everyone to convert to common shares. And then, sorry, were we surprised with the amount we raised going public? I mean, for the amount of revenue we were doing and the valuation we secured and the amount of money we received, I say as a point in time in history, yes, surprising and amazing. But at that time, no, it wasn't surprising. It was sort of as expected. And in fact, we restricted the amount of the raise. I think we were 7 times oversubscribed approximately at the time. And so bankers, I think, were encouraging us to raise more, and we held firm that's at most what we needed.
Yeah,
Yeah.
amazing. It's the cycles of the market, ups and downs, nonstop. Um, okay, well, secondary question here says, do you think IPO investors were too optimistic about Thinkific's future growth? What do you think?
I think that part of this the shift we've seen is the market, right? There's been,
Yeah.
if you tracked, I think I looked at it. It's been a little while since I looked at it, but if you looked at it at the 2-3 years after our IPO and you match Thinkific share price on a chart versus most other tech companies or Shopify or tech index, it tracked very similar, which is a bit disappointing that our quarterly earnings, even when we had good ones or good, and we've generally been a beat our guidance company the entire life of our public life. So a big chunk of it is moving with the market, but yes, we could have done better on the growth for sure. And I think expectations were high on what our growth rates would be. I mean, when we went public, all graphs were up and to the right, probably at an unsustainable rate. I mean, we were growing 70% year over year in 2019, approximately when we went public, or March of 2020, we peaked at about 150%. When we went public, it was still a very strong growth rate. And so, yeah, I think there were expectations at that point that we would grow faster than we have. I think the benefit today is if you're coming in today, you're at a place where I think we have a real opportunity to accelerate our growth rate from where we're at today. And if you look at our overall growth rate, compared to where Plus and Commerce are growing, there's significant chunks of revenue that are growing at 48 and 25% respectively for Commerce and Plus. So I think that represents a real opportunity for us in the future.
Yep, no, agreed. Since Thinkific has gone public, annual R&D expenses have been in the $19 to $20 million range. Do you expect this amount to increase or decrease over time? What is Thinkific working on? You sort of mentioned that already, but that sort of $19 to $20 million spend, where does that go from here?
Yeah. So I think generally at OpEx and EBITDA, we've been holding firm for quite a while now on just maintaining positive EBITDA roughly in the range where it's at now, which has been about 5%, a million last quarter. And I don't think we're going to deviate meaningfully from that. I think it's more a shift of of capital expenditures internally, or in terms of where we prioritize our investments more into R&D than other areas is where we see really big opportunity. That may translate into, and I'm still doing the math on next year and where the opportunities are and really making sure they are high ROI projects before committing to them. That may translate to a slight increase in R&D expenditures. I think but the only place we're going to do that is where we can be clear with ourselves and with shareholders of there's a very specific opportunity for a specific period of time where we have a high ROI and or ROIC, and we can do this in a specific way where we're going to get the return and measure it.
Mhm.
AI is the potential for one of those where I think we can put more there and see a big return on the investment just because we have some really specific use cases that we can monetize. But I wouldn't be signaling that we're going to see a big increase in R&D expenditure at this point. Again, it may change, and it's one of the benefits of having the cash is if we see that high return, we would come out and sort of share what we're doing exactly with that. And over time, I expect what we'll see is stage one is we want to see the growth rate of the company's revenue increase and then start to bring up EBITDA with that growth rate. But
Mhm.
growth rate first is the first step.
Mhm. Greg, I don't know many of your sort of comparables, but are there other publicly traded comparables out there, and how do you guys sort of match up to their valuations?
Yeah, there isn't and Juan, if you want to jump in, if you're on, if there's other stuff you can share that you think are good comparables. I know that we can be compared generally to tech. We can be compared sometimes to more LMS, although I'd say there's a big difference there. We can be compared to e-commerce. E-commerce is probably closer to the segment we're in, even than in e-commerce, not so much the businesses that are selling something, but the e-commerce software companies. Although it's really hard to compare us, obviously, to a Shopify. Radical differences there as well, even though the business models are somewhat similar. There is Docebo, which is they do bump up against us competitively, Canadian software company selling learning solutions. So that is one that could be compared.
Mhm. You did an SIB in the past, have you not?
We did, yes.
And what like the share price, if I understand, is lower than that. Would you consider doing another SIB? You did touch on that earlier. And if so, what sort of triggers you to think about doing an SIB?
Yeah, so the first one, we were obviously sitting on a lot more cash even than we were today. There was a lot of work with analysis and board to get an understanding of if that was the right move. The idea was that we'd started receiving a lot of feedback from investors that we were holding too much cash and it affected even the ability to invest because it was heavily weighted in cash. And so there was an opportunity there to adjust that formula better. There was also some risk in the US that we fell into this forget what it was called, but a kind of entity that is more about holding assets,
Mm.
and which created potential risk of different tax treatments there. So we cleaned that up through the SIB. And would we consider another one? Yes, I think certainly where share prices are at today, it's a smart investment, but I think it's a balancing decision for the board of really attractive investment and share price with having the right cash on hand to actually be able to jump on opportunities like M&A or some other investment opportunities if they pop up for us.
Mhm.
So
Um,
I wouldn't rule it out, but it's not
yeah,
actively being
yeah,
pushed or considered
yeah.
today.
Yeah, it sounds like you've got a handful of opportunities to deploy cash. Um, Gilles asked, well, he says, can you talk about Thinkific's relationship with Shopify? Maybe a few more details around that partnership.
Yeah, I mean, I've highlighted it that in their similar business and that they help people set up sites where they can process payments and sell physical goods, whereas we are selling digital goods, and there's some key differences there, but it's similar in a sense that we encounter similar customer challenges and things. In terms of partnership, we have I wouldn't call it a deep corporate partnership, but we have an integration with them. They have an integration with us. They appear in our app store. We appear in their app store. You can, if you are a Shopify customer and a Thinkific customer, you can integrate the two and have them work hand in hand. And you could even sell courses on Shopify that then are consumed on Thinkific.
Mhm. Greg, do you currently see a value to being public? Like is Thinkific being a public company, does it help the business in any way right now?
I think there's definitely some exposure benefits of being seen as a bigger brand and taken more seriously. I think certainly it helps with some of the partnership conversations, whether it's co-marketing or integrations or others, some of the doors we've been able to open that way with larger companies out there. So there's definitely some benefits that way. I do think it has still continues to have some trust building and brand recognition among customers. We have really strong brand recognition.
Mhm.
And so there is some benefits there as well. We get some additional press because of it. I mean, other reasons to be in the public markets. We're not looking to raise capital, obviously, at this point because we have a strong cash balance and we're profitable. And it does provide liquidity it does tend to make finding great talent a little bit easier because if you're giving, equity units or options in a private company, they are maybe one day, whereas for us, RSUs are more directly liquid when our employees need it. Interestingly, we have not seen a lot of employee selling. There tends to be really high retention of RSU grants to our team, which is great because they see the future value in the company and in where our share price could go.
Mhm.
So some benefits, but I get the question is like we're trading at a significantly more lower market cap than we were at. It's a different world, different market. Would we explore going private? I think it's always a possibility. It's not on the books right now where we're actively engaging in it, but the conversation has come up a few times over the years, and so there is the possibility. I mean, that's another downside risk protection to some extent for investors because going private would hopefully see a premium to all investors in a scenario like that. But I don't think it's us. I'd prefer to have the big win where we really accelerate growth rate and see an even bigger return for shareholders.
Yeah. Greg, have you or your brother ever sold any shares since going public?
Yes, I did not sell anything during the IPO. I did sell some about a year prior to the IPO, and that's in the prospectus with the details there. And then as part of the SIB, I did sell some then as well. And I can get into reasons, but largely it was paying off the mortgage and keeping my wife happy.
It's a good investment.
Yeah,
It's a really good investment.
yeah.
Okay.
But I'm still very hungry if that's the question. I've got to
Right, still
achieve
got
a
a lot
lot
of
more.
shares left by the looks of it. You got plenty to
Yeah,
go. Yeah.
yeah.
Um, how are highly technical employees recruited and are employees retained? Have employee options issued in 2021 been repriced? If not, does this suggest retention risk?
Okay, lots of good questions there. I'll take some of the easy ones first. The options were not repriced, but what we did do is we switched away from options and we started granting RSUs. And we granted enough RSUs in 1 year there that we sort of said to the team, forget the options. It's really difficult to reprice. We don't want to cancel them because you can't cancel without each employee's consent. So let's just forget they exist and give you some RSUs instead. So we've effectively replaced them with RSUs. So I don't think there's a retention risk specifically on those underwater options. Are employees retained? I think the honest answer is less so than when we were smaller, private, and pre-COVID. I think not so much the going public, but specifically being remote has definitely had a small impact. I would not say it's a problem. I think we're in a healthy place, but we used to have probably unrealistic employee retention rates. Our internal employee net promoter scores or like engagement scores, happiness scores were off the charts too high, like often in the 80s and 90s. And so the combination of going remote and then going through 2 rounds of layoffs definitely had a negative impact on that. I think we're getting back to, but are not completely in a perfectly healthy spot. And we've got some work to do here. The addition of the new leaders, the clarity of the strategy, and the adjustments we're making to the culture have had a big positive impact. And we continue to see for the last 4 quarters, like our internal scores going up in terms of engagement and retention. We're not in I'd say the scores of what the team is telling us need some work. The retention is in a pretty healthy spot. And then how do we recruit? It is one of the benefits of being remote is we can get the top talent regardless of where they are. So we're also looking at, exploring some low cost jurisdictions for more technical talent acquisition. I've got some new, very senior members of my team who have deep experience and have built teams in other countries where this is an opportunity for us. And a lot of it is networking from the existing team's network, which has worked quite well.
Mhm. Gotcha. Okay, next question comes from Jeff. Says, are you purposefully targeting 5% EBITDA to appease shareholders to the detriment of sacrificing growth opportunities?
I love this question because I'm asking myself this every day. No, I'm asking the leadership question this often. So I think for a short time that was probably true. and we needed to make some moves to maybe not completely to appease shareholders. It was also probably the right thing to do to prove to ourselves we could get back to profitability. Prior to going public, we were always break even or profitable. We were really efficient. We could have bootstrapped the whole thing. Even the money we raised, we really didn't need. Going public, raising 180 million Canadian with the green shoe, we moved into a phase where it was, and also combined with the growth rate we were experiencing, we wanted to invest significantly and did too much, bit off more than we can chew, grew the team too fast, made some bad choices there that I completely own. And we've since reversed, cut back on the team size significantly. That luckily is a couple of years behind us, or fortunately. I think we're in a much better position now and a lot more efficient with our dollars. And so I think now it's a really healthy mix of being efficient and ideally recognizing that I believe if a business is a good business, it should be able to be profitable, but we're also facing some really exciting innovation opportunities and growth opportunities. And so I think rightly so, we're having the strong debate and the trade-offs there of investing for growth and being really efficient with our capital deployment. And really the focus is not on appeasement of shareholders or perception in the market. It's much more on making the right choices for the company as to if we put $1 out and we're going to make $2 back, let's do it regardless of the near-term perception of EBITDA. And we can explain that to people when we do it.
Mm-hmm. Now, you grew over our revenues by about 12% last year. Is that, are you comfortable with that pace? Do you think you can grow faster? Is it, again, I want to try to get in your mind in terms of what you think the ability to grow is from here.
I'm not comfortable with that pace. I'm deeply impatient and not satisfied with it. I think we can do more. It is, and we've got really specific focus areas that I think are opening that up. If you look at Plus, it's growing at 25% right now. If you look at Commerce, it's growing at 48%. Even those have had faster growth rates, but on smaller numbers. I think there's an opportunity to lean into the things we're really good at and accelerate that growth rate. I would love to see us back as a Rule of 40 company where the majority of that is in growth, ideally, 30% plus growth rate. I think we've seen enough companies do that even at scale that it is very possible. And when we look at the things we have in front of us, if we do a lot of the right things, including adding some additional things to sell to our customers, add-ons or additional SKUs, there is a lot of opportunity to do that. I don't want to give guidance that we're going to get there by the end of this year. But it's an area that we're definitely leaning into and no, I'm not satisfied with that growth rate. We want to do more.
Mm-hmm. And outside of the sort of immediate verticals you're in right now, is there plans to get into other areas that we haven't spoken about yet?
There's, at least in the next 18 months, for a lot longer than that, there's a huge market opportunity that we're barely scratching the surface of that I think we just need to get really good and stay at what we're doing and focus on who we can serve best. We're not going to run out of revenue getting really good at that. So it's probably more within that, looking at what other problems we can solve for those customers as opposed to going to totally new verticals or customers. There certainly are areas that we could extend into. One example is the sort of land and expand. As we go into a company like Levitt, they are selling courses to their partners and customers. We could fairly easily add on the ability for them to train their own employees. Some of our customers do this. It's just not a core strength or something that we market heavily. But that would be a natural extension for us. We're going to stay away from that, at least for the next 18 months, just because there's so much meat on us getting better at what we're doing. Mm-hmm. And I think for right now, the name of the game for us is focus and just really tightly focus so that we can differentiate and be really strong at what we do.
Mm-hmm. Gotcha. Okay, next question is, how long is the average contract for ARR or RR?
Yeah. So in self-serve, most of them are monthly on a credit card, but a small portion, I forget if it's 10 or 20% these days, are on annual, might be more than that. But it's mostly monthly. On Plus, which is our sales-led group, which is about 700 customers out of our 35,000 customers and about 17% of our revenue. They are now, most are on annual contracts, but as of last quarter, we just moved to more multi-year contracts. And so last quarter, we saw about 50% sign multi-year contracts with baked in expansion. Mm-hmm. if you're asking the question, why did it take you so long to get there? I would ask myself the same question, but that's where we're at now. We've got new leaders in the area, and so leaning in on multi-year contracts has been a big push, and it's working great. Customers are actually liking it. And the great thing is it's obviously baking in retention and revenue expansion into those contracts. So we're going to see that increase over time as a percentage of customers, as every quarter should see at least 50% going into multi-year now.
Yeah. And Greg, I can't remember if you mentioned it, but what's your churn look like? What's your client retention rate right now?
Yeah, so we haven't specifically disclosed a churn number. I think similar to a lot of SaaS companies like Shopify, I find this can be misleading in some ways in terms of the expectations around SMB. It's fairly typical of your SMB SaaS or even comparable companies that way. What I can speak to, though, to give a lot more color on it is, the number one reason we see for churn from our customers is failure to start. So because we have a fairly open front door, that bottom price point's $49, and for a lot of our life, we've had a free offering and a free trial. It's really easy for a lot of people to come into the front door. It's another area where we're very similar to Shopify, and like then we see a lot of churn of people who sign up, and in the first month or two, they really haven't done anything. And so when that credit card bill hits, they cancel. That's the biggest area of churn. It's the vast majority of it. But I think with part of the reason with our shift more up market is we focus on these more successful businesses. They do come in and start at higher price points. They are more likely to go annual or sign multi-year contracts, and they do tend to churn a lot less and have more revenue growth baked in. So we should start to see overall retention, net revenue retention, net dollar retention increasing over time as we lean into this. I would say that it's a challenge for businesses of our type. I don't want to gloss over that it is a challenge to see, and there's opportunity for us to improve the overall retention to great benefit here.
Gotcha. Okay, next question is, given the extreme undervaluation of the shares, would you, your brother, and Rhino consider signing a share lockup?
Rhino's currently under a lockup. Personally, it is, and I don't know how long people would be looking for. I don't have any plans to sell or anything in the works to sell anything at any time soon. If I were to go to the TSX today and say I wanted to put in place some sort of selling, my experience last time I tried to do this is it took 9 months to get approval for it. So I almost have a bit of a natural lockup. I would have no problem, signing another 6-month lockup, but and I, even beyond that, I don't have any intention to do anything. I'm building for the long term here, but I'm fairly confident that if I press release tomorrow that I'd signed a long-term lockup, it would have no impact. So I'm not super fussed about going and doing something like this.
Gotcha.
Yeah.
Okay, next question's a long one, so you're gonna have to hear me out here. It says, I raise this in the light of the company's decision to recruit top talent from lower cost geographies, which is a refreshingly unconventional and forward-thinking approach. I'm eager to better understand how the company perceives the role of AI, whether primarily as a force multiplier for existing employee talent or as a tool to accelerate execution speed more broadly. In particular, based on current AI experimentation and early implementation, do you anticipate that any of the company's central KPIs could undergo meaningful change over the next 3 to 5 years?
That's a great question. So, and there's a lot to it. So on the force multiplier and talent, yes, we are looking at AI as a way to take the existing team and turn one person into 1.5 or 2 or eventually 10, times the efficiency, effectiveness, and deliverable ability. I think that we're, as a world, not just us at Thinkific, we're pretty early in that journey. And so it was 3 years ago, I came out with a memo, and I continue to push it every year as we set our planning. And it's now become part of our, well, I'll be specific about what it is, and then I'll say how we're enforcing it. But everyone at Thinkific and every team is expected to be using AI in their roles and in their teams and looking at how they can deliver more and be more efficient through the use of it. That's one side of using AI, and the other side is in the product. On the team using it, it's become part of our employee reviews. So as people are going in for performance reviews, compensation reviews, their use of AI is being considered, and their ability to force multiply and become greater because of the use of it. We've also put it in place as specific projects, like a significant portion of our support tickets, the sort of low value tickets that customers just want a quick answer to, are now being deflected through the use of AI. We've also built bots where on sales calls and coaching calls with customers, they can interact with these bots, or even our salespeople can interact and then share the information. That's allowed us to kind of leverage expertise across the team. And then on the product, we're investing heavily in using it in the product. And the beautiful thing is, one of the biggest strengths of AI is creating derivative content. And so we consume a lot, we're given a lot of content that is not publicly available. All the publicly available content is now gone into training LLMs. So the only sort of moat out there is the private data. Our customers are giving us their private data and content that we can use to train agents for them. So that's a really exciting opportunity. And then in terms of KPIs, I think the biggest one that we can move is average revenue per user and net dollar retention, which of course connect directly to revenue. And that's really because our customers, most people, are now expecting to pay per use, or on a sort of usage volume basis for AI. And so as we unlock more AI functionality in our product, for example, training an agent on our customers' expertise to interact with their students, it'll likely be billed on a usage basis, because we do pay on a usage basis. And so the expectation there is to flow through that with markup to customers. So that creates an excellent opportunity of increasing average revenue per user and increasing net dollar retention over time and increasing overall revenue.
Gotcha. Greg, with the share price down here, have you had inquiries in terms of other companies looking to buy you guys?
We have, but I would say, I've had varying levels of inbound since we were doing about $1 million in revenue. So it's always a thing that I think CEOs get that inbound. I continue to see it, whether it's in the form of strategics, private companies, competitors, or even private equity. Probably since we've been public, there's been acceleration of the private equity side. I'm never sure how much of it is spam and just sort of I haven't read anything about you, but here's an email. I don't spend a lot of time engaging in it, but I do believe, as a former lawyer and with a good understanding of what the responsibility I have as a board member and shareholder is, if there are serious offers out there, I make sure, we're going to take that to the board and have due consideration there. And if it is in the best interest of shareholders, then we would take a serious look at it. But I'm also not out there actively engaging in these conversations right now. I think there's too much meat on the bone for us to go and check out at this point. We really have to look at how do we accelerate the growth rate and deliver a lot more value. And if, maybe there's a way we do both, right? We dramatically accelerate growth rate, see growth, and then someone comes along and wants to partner again there. My hope would be it's someone where we can continue the vision, but I'm also still aligned with shareholders very much, and so want to deliver the best possible value. I think right now the best way we can do that is accelerate the growth rates through the projects we have underway.
Gotcha. Greg, you touched on this a little bit earlier, but I want to ask it in a different way. With insiders holding a substantial ownership stake, how does management balance its own long-term vision with investor feedback?
Management balances long-term vision with investor feedback. So
my guess is there's a lot of pressure. The stock's down from where it was years ago. It's not unusual to get public market CEOs getting, backseat drivers calling in and saying, I want you to do this, or I want you to do that. How do you balance that?
Yeah, I mean, look, I haven't had too much backseat driving, but I am also, I've been clear with my board that if the time comes, they believe I'm not the right person for the job, I won't use my shares to influence that decision. It really would need to be a board decision, though, like I think it should in good governance be at any company. I know that's not exactly what you're asking, but it is an element of trying to give you the flavor of how I am and how I operate as a person and a CEO, and that really high bar for ethics and integrity and no ego. And that if I'm not, and I've been honest with my team internally too, if I'm not the right person for this, like let's find the right person. I'm doing in every way the best that I can and learning and growing the whole way along, as I expect our whole team to. In terms of the backseat drivers, I treat it like I do and have we always all sort of coaching advice and feedback because I seriously consider it, think about it, and then you have to throw out 80% of it and keep the 10 or 20% that you believe in your best interest of shareholders and other stakeholders fits the bill in terms of our strategy and what we want to do. And so I do consider, and I get a lot of advice and coaching from whether it's from board members or coaches that I've hired or spent time with. And then we figure out where that fits into the strategy. But we've got I think, a really good plan, and some of it did come from advice and guidance from third parties, and a lot of it came from data. We did a huge research project last year, talking to existing customers, potential customers, competitors' customers, and that really helped inform the approach we're taking from a data-driven approach. So I also recognize everyone, including myself, can have opinions. Sometimes my opinions are more informed by 13 years of experience in the company and industry, but I generally trust more in evidence and data than anything else. So if people bring strong evidence and data to their coaching or advice or backseat driving, then I'm much more likely to look at it and take it seriously. But it's also got to fit with the strategy of what we're up to.
Mm-hmm. Gotcha. What keeps you up at night? What's the biggest challenge you face running the business?
Yeah, I used to say my kids, but they're much better now. They don't keep me up at night. So
That's your secret, because mine do.
yeah. Well, they're 10 and 7, so they're
Okay.
hopefully mostly. Last night actually was an exception, but um, I I mean, I am deeply impatient with everything that we are doing, and I think we're doing I think I've finally sort of got the right team, the right strategy, and a ton of opportunity, and I just want it to happen faster. And so I'm constantly leaning on how do we make these things happen faster, because I recognize that anytime you look at a return on investment or IRR or ROI equation, time is the variable that drives so much there, right? If we can put $1 million in and get $2 million out, and we can do that every week, that's completely different than doing that every year. So for me, it's driving intensity and speed in the team, and making sure we're doing the right things the right way.
Mm-hmm. And then what's the thing that gets you the most excited now, or what are you anticipating the most right now?
Uh, We've got a lot on the go in product that has been a bit longer term initiatives. There's some really exciting AI stuff that is just going into alpha this month. There's a bunch of alpha being like sort of testing it out.
Mm-hmm.
But a lot of the sort of public general availability to all customers releases are coming in Q4, Q1, and in some cases Q2, which is where the impatience comes in. But the combination of all of these things between AI, really big improvements across the platform in terms of look and feel and usability and some functionality for our bigger customers. Um, those coming together and the impact it'll have even on our pricing, packaging, and acquisition and retention numbers is just super exciting to see. So that's where I'm impatiently awaiting to sort of really push this out and get the results from it.
Mm-hmm. Greg, this has been fantastic. I appreciate the time you've given us today. Is there any sort of key message you want to make sure everybody walks away with today?
I think I've shared everything that came here to kind of talk about, and there was tons of really good questions. So, but if people have more, I guess they can reach out to you or reach out to us. I know Juhan's on the call, but ir@thinkific.com or investors@thinkific.com. And then we can get back to you if people have further questions or they're interested.
That's fantastic. This has been great. We've been speaking with Greg Smith, CEO of Thinkific, symbol THNC on the TSX. Greg, thanks for taking the time today and giving us a good update on the business.
Thank you, Paul. Appreciate it. Thanks for your time.
You got it. Thanks
Thanks
and bye
everyone
for
for
now.
joining us.
You got it. Thank you so much. Bye for now.